ค่ะโอเคค่ะสวัสดีค่ะก็ได้เวลาการนำเสนอข้อมูลของบริษัท PSL Shipping นะคะ PSL โดยคุณคาริดฮาชิมกรรมการผู้จัดการบริษัทและคุณกอตัมคูรานากรรมการการเงินของบริษัทค่ะและในช่วงสุดท้ายก็อาจจะเป็นคำถามคำตอบนะคะขอเชิญคุณคาริดค่ะ
Sawadee krab and good afternoon, everybody. We will do the presentation in two halves. In the first half, we will talk about the industry structure, and in the second half, Gautam will take you through all the financials of the company. So here you have a slide which shows you which portion of the dry bulk market in which pressure shipping is engaged in. So we have the cement ships, we have handy-size ships, and we have Supras and Ultra-Max ships. This is a long slide starting in 1985 and taking you all the way to the current date of the Baltic Dry Index. Just keep in mind that from March last year, the index has been recalculated. If you were to look at the same index but on an annual average basis, this is what you would see. You can see clearly that 2016 was the all-time low. The next lowest level was in 1986, and in 2015 was the third lowest level ever. You can see in quarter one, the index is around the low levels of the past. This shows you how the BDI has been progressing from the start of 2016 to the current date. So if you were to look at this, you would see clearly that there was a trend which showed you that the market was going up all the way up to the first quarter of this year when it started to come down. And now we have a gradual climb. Now the market is currently today above 1,000 points. If you were to look at the relationship between scrapping of ships and the Baltic Dry Index, you would see that it is an inverse relationship. It means that if the index is high, scrapping is low, and if the index is low, scrapping is high. So for example, if you look at the first quarter of 2016, you can see that the BDI was at an all-time low, much below the previous all-time low. And at the same time, in the first quarter, almost 14.25 million tons of ships were scrapped. Similarly, if you look at the whole year of 2016, you can see that with an average BDI of 673, an all-time low, we had almost 30 million tons of ships being scrapped. Now, if you look at what happened in 2017, you can see clearly that as the BDI kept going up, scrapping started coming down. So you have scrapping which started out at almost 5 million tons, ending up at 2.36 million tons. So as the BDI went from 673 to 1145, almost double, you can see scrapping has come down to half. And in 2018, it is even worse than that. Though the BDI went up by something like 20%, the scrapping came down to 1/3 of what it was. Now, with the market having come down in Q1, you can see that we have scrapped almost half the number of ships that were scrapped, or by deadweight tons, that were scrapped in all of last year. And what this slide does not show, because we are trying to show you only the Q1 position, what it doesn't show you that by the end of April, this number had gone up to 4 million tons. So scrapping has gone up in a very significant way when compared to the previous year. Now, what I've shown you here is what has been happening in China despite the trade war and all the other issues that are there. If you were to look at the results in Q1 and annualize it, that is multiplied by 4. This is not a good scientific way to do it, but if you did that, you would see that roughly for iron ore, China is going to import roughly the same amount as last year, give or take 1%. If it is coal, it will be positive by about 3%. If it is steel production, it is up significantly. If it is steel inventory, it's marginally up. Steel exports is marginally up, but China consumption of steel has gone up significantly. So what do we see? That despite all the trade war, China is producing a lot of steel and consuming a lot of it. This simply shows you the same position that I talked about just now, but in graphical form. And the same thing for soybeans again. Here is steel production, inventory, and exports. And again, you can see that some changes are taking place. And say, for example, in exports, it looks like exports have gone up a little bit compared to the previous year. But if you look at steel production, it's gone up significantly. Now, here is a table showing you that the GDP of China, if you just go simply by the headline number, what is the GDP growth rate in China, then you would make a big mistake in terms of iron ore imports or coal imports or steel production. Now, if you look at, or steel exports. So if you look at these numbers, it shows you a big disconnect between GDP numbers and the physical movement of cargoes into China. This is a slide that shows you what's happening to minor bulk cargoes. Now, this is what we normally carry, minor bulk cargoes. So if you look at this chart, this is from 16, 17, 18, 19, and 20. 19 and 20 are forecast numbers, and the balance are on actuals. So if you look at 2016, when we had the worst possible year, you can see that the overall growth in supply was 3.1%. and the overall growth in demand was just 1.8%. So demand was lower than supply. And remember, when you came into 2016, you already came in with a large surplus of ships. So any further surplus of ships pushed the market down to a level whereby owners started scrapping a lot of ships and scrapped almost 30 million tons of ships that year. If you look at 2017, you can see that demand grew by 4.7% while supply grew by 2.9%. And then if you look at 2018, this gap widened further. Demand grew by 5% and supply grew by just 2.3%. And we had a really good year in 2018. Now the forecast number for 2019 is for demand to slow down from 5% to 4.2%, but supply to increase from 2.3 to 2.7%. So we're coming closer to the gap which was there in 2017 in 2019. And if you look at 2020, then the gap widens a bit more. Supply is coming down to 2.1% and demand is growing to 4.1%. So the gap is widening. And these are numbers from Clarkson's. This slide shows you all the types of cargoes we've carried in the last 3 years, 16, 17, and 18. If we were to analyze the supply, then in the first quarter of this year, we have grown the overall fleet in the world by 6.33 million deadweight tons. And we have now reached a total of 843 million tons. If we look at the forward book, how many more ships are still to come in deadweight ton terms, then you would see that in the balance of 2019, that is the next 3 quarters, we would have about 4.21% or 35.25 million tons still to come. And then that goes up to 42.7% in 2020, drops to 12.94 in 2021, and 0.91 in 2022. Now, of this total is 91.8 million, or equal to say 10.97%. Now, of this 91.8 million tons, you can see here clearly that 73 million tons is all big ships, not ships in our sector. And in our sector, we have only 19.35 million tons still to come. This is a slide showing the order book in each year. In each year, when you place an order, how many ships have you ordered? So if you look at that, you can see how crazy ship owners went in 2007. They ordered 169 million deadweight tons of ships. And then they ordered in 2008 104 million tons. And then in 2009, when after Lehman Brothers everything collapsed, it came down to 38 million tons. And again jumped up to 104 million tons the next year. And one more time at more than 100 million tons in 2013. So you can see clearly ship owners are quite irrational in their way of ordering ships. When things are good, they order a lot of ships. But again, if you look at the last 4 years, that is 16, 17, 18 and part of 19, if you look at the ordering done in this part, you'd see that you have 90% of ships which are in the gearless sector, and only 10% of the new supply is going to be in our sector. Again, a slide to show you what has been the changes in terms of growth in ships, which is the blue bars, and the reduction in ships, which is the scrapping part, which is the smaller red bars behind. So you can see that in the first quarter of 2018, we had a net delivered of 8.12 million deadweight ton ships, and in Q1 2019 it has gone up to 9.14. So we have an increase of 1.02 million tons of new ships delivered in the first quarter of this year compared to last year. At the same time, scrapping has gone up, and if you see that, scrapping has gone up by more than 1.1 million tons. So if we were to look at it on a net position, Q1 for this year is very similar to Q1 of last year. This is the chart which shows you how we have been growing the world fleet. This is in numbers, how many number of ships we have in the world fleet, and this is at the start of each year. And this shows you the average deadweight tons per ship, and this shows you the total deadweight tons and what has been the growth over the previous year. Now we have forecast the growth for 19 and 20 based on these two assumptions. The first assumption is that there will be 20% slippage, and the second assumption is that we'll have at least 12 million deadweight tons of ships scrapped. Now we know that in the first 4 months of this year, we've already got 4 million tons of ships scrapped. So we think that this number will be exceeded by the end of the year, especially if the market remains where it is at. This slide gives you some analysis that we have done. First of all, this column is, that's the second column, is the column showing you world GDP growth rates as calculated by the IMF. The third column gives you the absolute billion ton mile growth, and then the fourth column gives you the percentage increase in the ton mile. Now based on this, what we did was that we first of all did a regression analysis between column 3 and column 2, and we found a 98% fit, which means that we are a derived demand from world GDP growth rates. If growth rates are strong, we do well. If growth rates are weak or negative, we do poorly. The other thing that we learned from this is that if you were to take 115 basis points as a rule of thumb to calculate what will be the ton mile growth rate compared to world GDP growth rates, then if you add 115 basis points, you would be 52% of the times absolutely right, and the balance times you'd be wrong, but within a margin of error. So let's say between 50 and 150 basis points is going to be the addition that you have to do to world GDP numbers to arrive at the ton mile growth numbers. This is the forward order book, and we've done this calculation basis the 1st of April, that is at the end of the first quarter. What have we seen? We've seen that there is 843 million deadweight tons of ships in the fleet, and if we look at the total order book, you can see that the order book is at 11.63% for the global fleet. And if you look at the fleet which is over 20 years of age as of today, then it is 7%. And if you were to look at the global fleet, if it was allowed to grow older up to 2022, then that number would come up to 10.55%. So this number 11.63 and 10.55 shows you that we are roughly running at replacement. If you then look at the same thing but just for the handy-size and Supras, you see something else. You see that in the handy-size it's a very good picture. You can see that we have a growth rate of order book of 5.5%, and against that we've got an existing overage fleet over 20 years of age of 13.36%, and if you were to extrapolate that to 2022, then it would be 16.75. So you can see that it's a factor of about 2.5 times or 3.5 times almost between the order book and the old age ships. So we think that again supply is going to be very marginal in the forward years. Similarly, if you look at Ultramaxes, what do you see? You see that the existing order book as of the end of quarter 1 is 8.12%, At the same time, the overage fleet is at 8.53%, and if you were to extrapolate that, it will come to 12.13. So roughly 1:1 as of now, or 1:1.5 if you're looking at the forward picture. Trade wars and tariffs. I think the latest round has been where Trump has removed, he had given a moratorium on tariffs. Now he has increased the tariffs, and China has likewise retaliated with more tariffs. Now what do tariffs do? They don't do anything to us as dry bulk. We still have moved cargo, but they make the rest of the world very nervous and make GDP rates come down. When that happens, it will affect overall demand for us. These are the regulatory changes that are coming. Please read it at your leisure. It gives you a lot of detail. But the two things which are quite important, one is ballast water management systems, and the other is IMO 2020, or the burning of low sulfur fuel oil in ships. So if you look at the low sulfur part of it, you can see that we were burning 4.5% sulfur oil all the way up to 2012. In 2012, this dropped down to 3.5%, and in 2020, it is scheduled to drop to 0.5%. If you look at, excuse me, if you look at the emission control areas, or the special areas in the world where you cannot burn dirty oil, or you can't burn high sulfur fuel oil, you can see that we were burning 1.5% oil all the way up to 2010. Then it dropped by a third to 1% till 2015, where it dropped by 90% to 0.1%. Now, if you look at these two lines, you get the feeling that going forward, they will merge into one and probably come to zero. So the world is getting more and more difficult with dirty, burning any form of dirty oils containing sulfur. Now, what does IMO 2020 mean to owners? You have only really speaking three options. You can switch to scrubbers, which is what I showed you on the first slide with the picture, or you can buy low sulfur fuel oil, which is available, and all oil majors have confirmed that it will be available by the 1st of January 2020. And then you could also switch to LNG. Then there's no question of sulfur at all. Now, which fuel should we use? We have gone for low sulfur fuel oil because at the end of the day, if you use a scrubber, there are a lot of issues with it. The first and most important issue is that the American courts have criminalized, had a felony charge against a company called Carnival Cruise Lines, which is one of the biggest cruise lines in the world. They put a felony charge against them for polluting the air. They use scrubber technology, and it shows you how poor this technology is and how badly it works on a ship. So they were fined, they were actually put on probation, and they had to have external third party monitoring them. Now that report was supposed to be secret, but the amount of times they failed, their systems failed to perform was so large that the court actually in April opened up that thing and showed the whole world how many times Carnival Cruise Lines, despite being made a criminal and under monitor by a third party, breached the rules. They were actually burning high sulfur fuel oil in low sulfur areas because their scrubbers did not work. So scrubber technology is not good technology, and we have stayed away from it. This is the number of dry bulk ship owners who have already retrofitted or plan to retrofit their ships with scrubbers, 563. And if you look in the brand new ships which are on order, another 122 will become scrubber fitted, which means that overall you'll have 5.5% of ships fitted with scrubbers. That's it. The balance 94.5% will use clean oil or low sulfur fuel oil. Similarly, if you look at LNG, only 6 owners have retrofitted their ships with LNG because it's so expensive and it requires the crew to undergo a lot of training. So the capital expense is about $10-12 million per ship, and it's quite ridiculous to really go in for this solution. And similarly for brand new ships, only 5 owners have gone for this. If you notice, the main owners who are doing LNG is gas carriers, again in both brand new and in existing. And the reason for that is all gas carriers have to give off some gas, some of the gas which they keep in liquid form evaporates, and that evaporation they can actually pipe back into the, otherwise it will just go in the atmosphere, which is bad. They can now pipe that into the ship itself. This shows you what ships are at risk of spending a lot of money when their special survey comes up on their 20th birthday, 25th birthday, 30th birthday. Now this is for the global fleet. It shows you 42.1 million deadweight tons of ships will have some sort of a birthday coming up in 8 quarters, starting in first quarter of this year, ending in last quarter of next year. Now these ships will have to fit ballast water treatment systems. They will also have to worry whether their old ship will be able to burn clean oil. And if you were to only look at our size of ships, that is the geared ships, 18 million tons of that 42 million is from our sector. Now, if nothing happens to those ships, nothing is done, they all survive and they can manage, then you'll have at the start of 2020, and none of them are scrapped, you'll have 66 million tons of ships, and that will go up to 76 million by the end of the year. So this slide tells you what the oil majors are doing about oil. They've got plenty of, they have plenty of oil available. I've given you all the details. What steps will owners take? They will start to slow down the ships. If the gap between clean oil price and dirty fuel oil is large, then you'll slow down your ships a lot. If you slow down your ships a lot, you will reduce supply. If you reduce supply, markets should go up. So what is our strategy going forward? Going forward, we're just waiting for the market to improve sufficiently so that we can lock in our ships on long-term contracts. This is a picture of the company. We have 36 ships as of the end of the first quarter. The average age is around 7.28 at the beginning of the year. This is the insured value, the market, the book value, and this is the total deadweight tons, or average of about 44,000 tons per ship. This is the forward order book, forward revenue book. So here you can see we have got, like for example, in 2019, $33 million worth of fixed contracts where we will get this money into the company. Similarly, you can see it starts to slow down because one ship which is on long-term contract will come off the contract in 2020. And then you can see that it remains roughly same or comes down slightly because one more ship will release from long-term contract. So this is the forward position. This gives you the rate. This line gives you the rate at which we are fixing the ships on long-term contracts on an average. This gives you the number of days in the year, and this gives you the number of days that are fixed on long-term contracts. And as a percentage, this is the line. This is the position of the company for quarter one. In quarter one, we outperformed the handy size index with our 19 ships which are there in the handy size fleet by 44%. In the Supramax sector, where we've got 9 ships, we outperformed the index by 27%. And in the Ultramax sector, where there is no real index, we have got 8 ships where we outperformed the Baltic Supramax index by 31%. So again, we outperformed all the 3 indexes. So to briefly summarize, 2017 and 18 taught us that demand supply are very close by and in balance. In 19 and 20, demand growth is going to be about 2% more than supply growth, which means that we should do quite well. But because of the trade war slowing down the whole world, that may not be a reality for this year, but certainly for next year. If you look at the order book to existing fleet ratio, it's one of the lowest in the world in the past 10 years. And we know what happened when, or rather up to the turn of the century. And the last time that this number was as low as this was in 2002. And after that, you can see the market going up very sharply. Question of low sulfur fuel oil will come up in 2020. Since our model is of time chartering our ships out, it's a customer cost, it doesn't affect us. Cost of capital has gone up because interest rates have gone up, and therefore less people are ordering ships. Future environmental rules are getting more and more difficult, and nobody knows what new rules will come out. Therefore, people are scared to order more brand new ships. There are only 2 things which you have to be careful about. One is geopolitics. that can have a big impact on shipping. And the other one is the use of tariffs by Trump, because he's now finishing off with China, then next he wants to attack the European Union. So this will not be something that will go away quickly. Now Gautam will take you through the financials.
Thank you. So our results for the first quarter of this year, we reported a loss of $2.67 million. This was compared to a $4.56 million profit in the last quarter of 2018 and a $3.43 million profit in the first quarter of 2018. This is driven by lower average TC income per ship, which came in at 9,273 per day, compared to 11,274 per day in the last quarter and 10,965 per day in the same quarter last year. Our average ship running cost per day came in at 4,816 per day, compared to 4,785 in the last quarter and 4,482 in the same quarter of last year. Our profitability is linked very much to the average TC income per day per ship. So for every $1,000 increase in average TC income, you see about a 10 million increase in profitability. So which is why we saw in this quarter, in this last quarter, the average rate going down has affected profitability. Gross profit margin still remained quite healthy. It was 52.68%. Net profit margin was negative as a result of the loss, 8.77%. Moving on to, so liquidity for us remained quite healthy. It was 71 million, slightly down from 74 million at the end of last year, but still quite a healthy position. The advances to Senti remains the same, 64.12, same as last quarter. Total asset position declined a little bit. It was 857 million in the last quarter. It's down to 848 million. This is due to the depreciation of ships. Long-term loans has declined as well from about 278 million to 269 million. This is in line with our strategy to reduce our debt. Debentures, it shows an increase of 169 to 173, but this is actually, these are Thai baht denominated bonds, and this is the translated version over here in US dollars. Actually, we've swapped, our exposure is swapped, so our exposure is actually 154 million. That exposure doesn't change at all. Shareholders' equity has declined a little bit. It was 391 million in the last quarter. It's down to 388 million as a result of the loss. Book value per share is 7.93, again down a little bit from 8.14. Total debt to equity is also down marginally. So it's 1.18 compared to 1.19. Again, this is in line with our strategy to reduce this ratio. Our operating expenses for the quarter were slightly above our target. They came in at 4,816 compared to our target of 4,750. This was because of some dry dockings that took place for some of our younger ships. Which therefore we saw an increase of dry dock special survey costs, which was 479 for last year. It came in for the first quarter at 596. Other than that, the numbers are more or less the same as last year. This table shows a comparison of the OPEX, of our OPEX, with the average OPEX for the industry for the same types of ships. You will note that on average, we are about $1,000 lower in our operating expenses per day, lower than our competitors, than the industry average, rather. And if you remember, I said $1,000 increase in revenue translates to a 10 billion profit. So this is quite a sizable amount. So yeah, we continue to be quite competitive in this area. Over here, we look at the, okay, for the top line over here, the top bar shows the average age of our fleet. So you will note from 1995 to about 2011, the average age of our fleet was about 15 years. Thereafter, we went for a fleet renewal program, following which there was quite a sharp decline in the average age of our fleet, which was 5.83 at its lowest point in 2016. It's currently 7.28 years. The line below that, starting with in 1995, it shows the average deadweight of our fleet. You will note that in 1995, the average deadweight was 19,514. It is today 44,050 average deadweight, and this is because we have taken delivery of 8 Ultramaxes over the last 5 years, so that's brought up the average age of our fleet. These are, of course, very modern, eco-friendly ships. The line below that, the middle line, shows the average time charter rate from 1995 to present. And you will see, so in 1995, we had a good market, what was considered a good market at that time. The average time charter rate was 7,300. However, as a result of the Asian financial crisis, there was a gradual decrease in the average time charter rate. It bottomed at about 98, 99. And then we started to see a slow ascent in time charter rates, driven in a large part by the growth of the Chinese economy. So we saw 2 peaks, first in 2005 and then in 2008. And then thereafter, after the Lehman financial crisis, there was a decline of average time charter rates. Time charter rates bottomed in 2015 and 16 and have since begun to increase gradually. Operating cost followed a similar profile to an extent. There was a bottoming of operating cost in 98, 99, and then we saw a gradual increase. The peak was probably in 2009, but this is also when the average age of our fleet was about 20 years, or 17 years. And of course, the older the ship, the higher the operating expenses. Then as we started to take delivery of new ships, there was a drop in that operating expense number. But again, our fleet is starting to age, and costs are going up a little bit over there. So the latest number is 4,816. This shows the evolution of our debt, total debt over time, as well as the debt to equity ratio. So the debt to equity ratio peaked during the Asian financial crisis. It was 3.79. And then we saw a gradual decrease as markets improved. It came down to 0 in 2006. And then as we went for our fleet renewal program, we funded a lot of this by debt again. And so the debt number has gone up. It peaked at about 1.26 in 2016. However, as I say, it is our strategy to decrease this over time, to bring it to probably about the 0.7, 0.8 level. We're currently about 1.1. Over here again, this shows the debt to EBITDA. So this is a cash flow measure. Cash flows during the Asian financial crisis, as well as during the period 2015 and 16, were extremely weak, and that gets reflected over here. Also, we had quite a new fleet in 2015, 16, so our debt levels were high. Coupled with that, earnings were weak, which is why the debt to EBITDA ratio was quite high. However, the trend is good. It's coming down. We expect it to go down further over time. By the way, this formula does not take into account the cash that we have on balance sheet, so this is gross. This is a gross number. This graph shows the cash operating P&L as well as the operating P&L, what we report. So as I said, we reported in the latest quarter, we reported a loss of 2.67 million. However, on a cash basis, we are still positive 5. And you will see in our history, there's very few occasions where we have actually had a cash deficit. There's only one period in our history, in 2015 and 16, So notwithstanding the fact that we had an accounting loss, for the most part, we were still cash positive, except for that very brief period in 2015 and 16. So this graph over here shows the net profit, again the operating cash profit, but together with the number of ships that we have. And you will see, so the size of our fleet in nominal terms peaked in 2004-5 when we had 54 ships, and that declined. Our ships got older, we sold ships, we recycled them. And then we went for a fleet renewal program, and then we did some more recycling, and we're currently at 36 ships. Now, while it may seem like we have fewer ships, but when we look at this in terms of deadweight, the size of our fleet has actually grown because we have bigger ships on average. This shows the dividends that we have paid over time. Our policy is to pay not less than 25% of net profit as a dividend. Now, for obvious reasons, we have not paid debt for the last few years. Market's been very weak. Our aim is to start paying dividends again once debt levels come down a little bit. This is the financial profile. Again, you will note a couple of things. So our cash balance has improved substantially over the last few years. Total assets remains more or less the same. Debt has been going in the right direction. It's going down. The number of vessels is declining seemingly, but however, as I said, the actual deadweight is more. And EBITDA also, compared to the last few years, compared to 16, 15, EBITDA is coming to much healthier levels. So just a few of our awards over the in 2018. So PSL, Pressure Shipping, was nominated as Operator of the Year by 3 agencies, so Seatrade, Lloyd's List, and the International Bulk Journal nominated us for Bulk Ship Operator of the Year. Our ship management subsidiary, GCSA, was also nominated for Best Ship Manager of the Year by Seatrade and Lloyd's List. And also we had one of our ships, which is the Apinya Nari, a cement carrier, was a finalist for Bulk Ship of the Year last year. Also, most recently, we were nominated for Board of the Year in our category, which is for companies with a market cap below 30,000 million baht. Corporate governance, over the last 9 years, we have achieved a 5-star corporate governance rating. And so over the years, we've received a number of awards in this area. Yeah. So Marine Money. So Marine Money ranks global shipping companies based on performance. And on one occasion, we've been ranked the #1 shipping company in the world, around 2006, I believe. Most recently, we were ranked number 32 in the world out of about 100 companies that they rank, 100 global shipping listed companies. If we compare ourselves to other dry bulk companies, globally, we were ranked number 3. Out of 19 dry bulk companies, thereabouts, or 18 dry bulk companies. And so from the period of 2005 to 2012, we were ranked in the top 10 for an extended period of time by Marine Money. Marine Money is a New York-based ship finance magazine publisher. this shows the dividends, this shows the return on investment that our investors would have received from the time of IPO until today. So if you had invested at the time of our IPO, you would have received about 11 times of your original investment, which is quite good. Yeah, and this over here shows 1,000 baht, what return 1,000 baht investment would give you if you invested in 1993 at the time of the IPO, 95, 2000, 2005, 2010, 2015. You will note that, so again, so if you invested at the time of the IPO, you'd get about 11 times. If you invested, however, in 2000, you would have got about 50 times. The last few years have been weak, and so you would have got well, a little bit less than what you have invested. That would be the value. So I will close with that, and I guess we open for questions.
I have two questions. You kindly mentioned about the U.S.-China trade war impacting the demand side as well as the IMO 2020 impacting the supply side. I just want to ask about the net impact of these two. Which do you see as having the larger impact going forward? And my second question is about the trade war. What do you see the odds of the trade war resulting in a global economic slowdown, which results in the BDI being around 1,000 or the sub-break-even level, and how are you preparing the financials of the company in case of this scenario? Thank you.
Okay, so to answer your first question, the trade war and its impact on the BDI and IMO 2020 and its impact on the BDI. I think both will be very positive if they are in the right direction. So for example, if the trade war is finally resolved, then it should do a very big thing to change the sentiment in the market and improve the market quite considerably. The second thing is on IMO 2020. IMO 2020 will affect the supply side very strongly, because the older ships, from whatever we've been able to see at various technical conferences, we get the impression that the older ships will find it very difficult, if at all, to burn low sulfur fuel oil. So if either one or both of these things happens in a strong and positive way, it should help the market going forward. So let's say that the trade war continues, but IMO 2020 comes in a big way for the supply side. See, when trade war affects the market and brings it down, scrapping will go up. So supply anyways will reduce, right? And then over and above that, IMO 2020 will force many ships out of the market. When that happens and the net reduction is so high, then you will see that even in a low market, we'll still get a good return. Now, coming to trade war, if it continues, and how will it impact the GDP? I think it will have an impact on the GDP because sentiment is becoming negative. It's not that the trade war actually results in any less trade taking place. That doesn't happen. But because everybody is so panic stricken, oh my God, there's a big trade war going on, China might slow down. But China will not slow down. China will continue to expand, because see, as I showed you on the slide, giving you the first quarter results of China in terms of, don't look at the GDP number, just look at their imports and exports. And if you look at those numbers for the dry bulk side, they're pretty strong. And this is without any real stimulus actually making an impact. They have started the stimulus, but it's not yet made an impact. We think the impact of the stimulus will start to come in Q3. So China will not slow down. They will continue going up even if the trade war continues. But the question is that will the rest of the world manage? And there I have a lot of doubt. Because you see, one of the simplest things that you can think of with the trade war is that the American consumer will have to pay 25-30% more on everything that he buys that he was buying previously at a lower price because of the tariffs. Now, that money will go to the American government. And you know how governments are, they love to waste money. And the American government is the best at it. No other government in the world is as good as them in burning money up quickly. That leaves the American population with less money to spend. but they don't have the money. So because the prices of things have gone up much higher than what their salary increases are. Here, the cost of every commodity has gone up. I mean, Trump is so simplistic that he tells Americans that, don't worry about the trade war, go and buy American products in Walmart. But in Walmart, there are only Chinese-made products. There are no American-made products. And their price will have gone up by 25% as per the tariff. So it will be very tough for the American consumer because the salary has not gone up by 25%. So they cannot spend as much. Now, when they don't spend as much, what will happen to America? Markets will start to slow down. America might go closer and closer towards a recession. We hope that it doesn't happen, but it will come towards that. At which point in time, of course, the Federal Reserve will start to cut interest rates. So that is the measure by which the central bank will try to hold the economy up. Now, what are we planning for this? We are planning to reduce our debt as fast as we possibly can and as quickly as we can. And that's what we're aiming to do. Because the lower the debt we have, the less cost it will be to us to when we are running the company. So we will try and make all our costs as low as we can. Now, right now, our operating costs are high. We are trying and looking at what measures we can take to try to reduce those costs. So we will try in every way, try to reduce the cost, try to increase the revenue if it is practical, and at the same time, try to reduce the finance costs. So that's what we'll be aiming to do. Slide number 50.
Yeah, net profit
Yeah.
to cash
Yeah.
profit, excellent.
Yeah.
I would like to know and to add one more slide in future, net profit to operating cash flow. If operating cash flow is higher than net profit, means your cash management is superb. So please add this one, or
Sure.
should not add, you can internally evaluate. Number two, your nomination for Board of the Year Award 2018, and it will announce in June, July 2019. I wish you good luck that you should be
Thank you.
chosen. Thank you.
Okay, if there are no further questions on the floor, we have quite a few questions from the net. So if I look at question number 1, it says, according to slide 16, they want to know what is a geared and a gearless ship. So geared ships are ships which have their own equipment on board to load and or discharge cargo, whilst gearless ships are solely dependent on shoreside facilities to load and or discharge cargo. The second question is, is asking, is scrubbers profitable? As I said in my presentation, Carnival Cruise Lines, which is the single largest cruise company in the whole world, they have been declared as a felon. You know what's the meaning of a felony? It's like a serious criminal charge. So they've got a criminal charge against them. And one of the things that the American government did is that they said that they have to be monitored by a third party on this one issue of scrubbers, because they were cheating on emissions. They got caught, they were fined, they were called a criminal, and then they were put in a monitoring position. Now this report, which normally comes out of such a court nominated or appointed monitor, is generally kept very private and only revealed to the court, not to everyone else. But the court was so shocked with the amount of times that Carnival, after being called a felon, after having been known to cheat on emissions, was still committing the same crime. So the court got very angry and released the results. So in April they released the results. More than 100 times they have released because the scrubbers didn't work. So scrubber technology is not good technology. It is not meant for the sea. And remember, Carnival Cruise Lines is one of the first few adopters of scrubbers. They adopted scrubbers something like 10 years ago, and it still doesn't work. So what does it tell us? It tells us that this technology is not meant for the sea. They want help on situation iron ore production, weather disruptions. Okay, so the next question is on the Brazilian mining disaster and what are the weather patterns in Australia and how are they going to affect iron ore shipments. Now, this has already happened. So the mining disaster made the rates on Capesize ships, which was at above $12,000 a day at the time of the mining disaster, to come down to less than $3,000 a day. They're back up at more than 12,000. Why? Not that the mining disaster has reversed. It still means about 50 million tons of iron ore will be missing this year, will not be available for supply. And the reason why the rates have gone up is that the Capesize ships have done two things. One is they've scrapped a lot of ships. Out of the 4 million tons which I told you were scrapped up to the end of April, the majority of it is Capesize ships. In fact, in and up to the end of April, more Capesize ships were scrapped this year in the first 4 months than in all of last year. Okay, so that is one action that the Capesize ships have taken. The second action that the Capesize ships have taken is that they've slowed down the speed, and as a result, the supply has reduced, both from scrapping and slowing down the ships. And as a result, as you can clearly see, the rates which came from 12,000 down to 3,000 have gone back up to 12,000. No more? Okay, that's it. There are no more questions from the net.
I have appreciation for you regarding ROA. Return on asset is higher than ROE. This is a good appreciation. And regarding cash cycle in days, you were having previously 11 days, now you improved to 6 days, also high appreciation to you. Regarding net profit growth or margin of safety growth, you can see it further. And what I am thinking, that you are having current ratio declining because of your current portion of long-term loan repayment, and after that it will improve. But what I suggest, when the cycle is coming up, taking the turn, please re-borrow back, because Thailand is enjoying the first lowest and second lowest policy rate of central bank. So any opportunity you see, you can re-borrow it and invest in new ships.
Thank you. Yes. Excuse me, can you just pass the mic? Sorry. Thank you.
I have two questions. One is about the scrapping prior to the IMO 2020. Would you expect to, for the ship owners to try to not scrap before the IMO 2020, since they have to do it anyway after that, so scrapping for the remainder of the year might be low? And two is, after IMO 2020, when do you expect to see the scrapping take place, as in right at the start of the implementation of the rule, or during the dry docks or the regular maintenance schedules?
So first of all, for your first question, will scrapping slow down this year because owners will say we don't need to scrap till 2020, we'll scrap only after that? It doesn't work so smoothly. First thing is the market. Remember, the market makes a big difference. When the rates for Capesizes came down to $2,000-3,000 a day, they all scrapped a lot of ships, right? So the market makes a big impact, much bigger impact than anything else. So if the market comes down, which may happen because of the trade war, if it continues, then for sure more ships will go for scrap, because then the owner will lose hope of when will the recovery start again. So might as well scrap the ship, because I'm losing money every day. Faster I get rid of the ship, I'll stop the bleeding. So this is the first reasoning behind scrapping of ships, is the market. Market forces that. The second, of course, is regulation. Now, if you are a company like ours, a public company, you don't want to take a risk on the older ship to burn low sulfur fuel oil, then what will you do? You will think of selling it earlier, either sell it as second hand or scrap it. So it depends on the type of owner. Most owners are private, very few are public like us. The minority is public, majority is private. So private owners will try to push it right up to the last date, and then they will try to push their engineers to burn low sulfur fuel oil on an old ship which really can't do it. And then when the ship breaks down finally, then they will give up and then they will go for scrap. So if there are no further questions, then I should really thank you guys for being such a good audience. Thank you so much and for asking such good questions. Thank you. สวัสดีครับ